Welcome back to Passing Notes with Chaz Guinn. My name is Hayes Brumbeloe. I am your host, and I am happy to be back again for episode 2. I want to dive back in. Obviously, some of the conversation that we had in episode 1, we talked about how buying notes is different than the traditional real estate investment. Let's dive into that a little bit deeper. Let's peel the onion back. So how is buying notes different than investing in traditional real estate?
It's mainly different because of the hands-off approach, right? I'm an active manager. I'm an active portfolio manager. Our team is, right? So we don't offshoot the interfacing between servicer and ourselves to someone else. It's us who is doing it. And our servicer is the one who's day-to-day speaking with our homeowners throughout the country that are facing different levels of delinquency. So how this traditionally differs from just, your Chip and Joanna, your flip and flop type of play is what's the sourcing there? What's your deal flow there?
Sure.
Okay. Are you wholesaling everything? Are you going to auctions? Are you having to do mailers? Where's your flow like? And then whenever your flow comes, are you only sticking in your backyard? Right? For us, we preach and we teach a lot of the time that folks need to get outside of their backyard to truly scale in this business.
100%.
Go where the deals are.
No
Hayes.
doubt. Yeah.
And so for us, chances are there are opportunities if you're in Texas, in Ohio.
Right.
What do you know about Columbus, Ohio,
Right.
Dayton, Ohio? So for us, that's where I feel like there's a major difference. I can start having footprints in most MSAs in most cities across the country where if I was a traditional rental guy, I only want to be in my set area.
You want them close by.
I want to drive them.
But that's kind of you have to change the mindset for some of these investors where it's like, it's okay that it's in other parts of the country because at the end of the day, it's still doing the exact same thing.
You're still getting the cash flow, or
Absolutely.
you're still getting the property back through the real estate, and now you're putting it into a rental or a fix and flip play.
Exactly.
That's why we really spend a lot of time when we get to know you as a client, we get to know you as a partner, a vendor, a buyer.
Sure.
It really kind of goes back to us building long-term relationships from the get-go.
Sure.
So what is your goals?
Right.
Are you looking to be hands-off? So you want some kind of passive monthly cash flow? Well, let us show you investments that we have today that will fit that criteria.
Sure.
Okay. I don't know all the different exit strategies that align in just traditional real estate investing. It's one of two things. You're fixing, flipping, you're in and out of the deal, or you're creating a rental, right? Here in notes, there's 5 to 6 major exits that you can get in and out of an asset inside of a year.
Let's talk about it.
Right. So one of them is you're buying an asset that is in potential active foreclosure. It could be in the middle of the process or it could be in the later stage of the process. But your goal may be to get to the real estate, but the homeowner raises their hand and says, Hayes, me and my husband are back together. COVID broke us up,
Yep.
but we're back to work. We want to keep our kids in the same school district. We want to stay and pay. But can you work with us on a forbearance, a loan modification, some sort of repayment structure?
Right.
Okay.
Right.
So now you're taking a non-performing asset and you're helping to create it into a re-performing asset. And now you're cash flowing it all along the way.
Sure.
Let's say you hold that paper, they'll hold this example for 6, 9, or even 12 months. So you've been cash flowing the whole way. And there's a market out there where you now can package up your RPL, your re-performing cash flowing asset, and flip the deal.
Yeah.
Chances are you're making a very healthy return, and you got to keep the homeowner in the house.
That's the kicker.
Isn't that butter? So strategy number 1. Strategy number 2 is, what if you're a guy that you look for vacant assets, non-occupied properties, right? And you can tell that in the Excel spreadsheet, or you can tell that in the data that we share with you. And let's just say you're like, look, I want rentals. Okay, I already see that the homeowner's emotionally detached from the asset.
Sure.
They've moved to...
That's why it's vacant.
That's why it's vacant. So you know the story of, hey, look, we want to stay is not going to be relevant in this scenario.
Right.
So another exit is to go ahead and finish out the foreclosure through your servicer, who's going to be tapped into your local national attorney.
Right.
That's going to take that asset through the process. And now they're going to rinse and repeat and give you assets. Now you're creating a rentals right then and there.
There you go.
Strategy 2. Strategy 3 is, what if you already had a spotty paying, we call them reperforming or sub-performing assets, meaning over the course of a 12-month process, they made 5 payments, 6 payments. every other month you just can't quite keep up.
Sure.
Right?
Sure.
This could be because maybe they had a job correction where maybe their monthly income has now been dropped.
Not working as much, whatever it may be.
Whatever the scenario is, but they want to stay and pay.
No doubt.
Can you correct it? Chances are you can, because financially you have the room to correct it, because chances are you bought it at a good enough discount.
Correct.
Right? So now you have the room to potentially bring them down, stabilize the cash flow. Again, you can rinse and repeat and then sell that reperforming asset.
Absolutely.
That's strategy 3, but what about strategy 4, where that reperforming asset now is clicking along? Maybe it was an 8% rate because it was back in the subprime days, and now you've corrected it. Now you've gotten them back onto performing status, and they refinanced the mortgage because they made consistent 12-month payments.
Right.
And you're the lender, you're the bank. Now you just got paid off from the borrower's new lender. Another strategy, right? All these different ways are how note investing differs from traditional investing. Right?
Thank you for diving deeper. I mean, I think that's going to be super helpful for the audience to really just understand the real difference between notes versus the traditional real estate. Absolutely love it. Absolutely love it. I think it's a huge opportunity. I mean, think about it. It's like it's been hidden. I'm not saying it's been hidden, but it's just like, I mean, when you peel the onion back like you just did, I mean, the light bulbs just go off of just like, man, you're not only just creating long-term, wealth creation for yourself, but you're also helping communities, helping families. Because at the end of the day, there was a lot of things over the last 2 years that were outside of a lot of people's control. And it's like, man, it's just, I love it.
And you do, because, and you and I talked about this offline, and we talked about how many things can you put your money into, and there's multiple different ways of getting out of it.
Right.
It's usually like plan A or plan B, rut-row.
Yeah.
Now which way you going?
Yeah.
And so here, there's these multiple different paths, and they all benefit the outcome of the homeowner.
It's a win-win.
It's a win-win.
For sure.
Right? What about a deed in lieu? Cash for keys. Have you ever heard of this term?
Oh, yeah.
We have cash for keys, where it's like, look, instead of finishing out the foreclosure, Mrs. Jones, and being able to potentially ruin your credit for the next 7 years, why don't you sign the house over to us? We'll pay your first and last month's rent down the street.
Right.
We'll get you the moving truck and allow your life to mainly stay the same.
Right.
Or what if you sign the house over to us? We give you cash for that, but now you become a renter and you can stay put and not move.
Right.
These are all ways to benefit the current occupant.
Sure.
And you as a lender, as an investor. All different strategies of how.
I think I think you just rattled off number 5 and number 6.
There you go.
You know what I mean? So I mean, to have 6 exits, I mean, it's just it's unique, and that's why I think the audience it's these nuggets that people are, they're going to absorb quickly.
It's time.
One of the things that we talked about in the last episode was how our current market conditions are different than 2008. Now, from a flow standpoint, let's dive into why you think that the flow is going to be what it is over the next 12 to 18 months. Let's talk.
Sure. I have this debate all the time.
Let's pass notes.
Let's pass the note. I always talk the time with mortgage brokers, loan officers today, real estate agents, and they're like, look, where's this recession? Right? I think the media does want to have us believe there's something different going on than what's actually going on.
Right.
And that to be said, I'm still not seeing the recession kind of showing up into today's pocketbooks, right? But we are measuring far more data than maybe the traditional investor is, and why we feel like the market is coming right to us.
Right.
Okay. A lot of folks have been saying maybe there's a crash coming. There's clearly a correction coming. The values have been on a tear for like the last 36 months. We've seen unprecedented home price appreciation, HPA. We haven't seen this sort of kind of uptick level in a 3-year span in I don't know how long, decades. And here we are in terms of a market conditions where we're starting to kind of monitor what's happening on people's T&I. We always talk about PITI, principal, interest, taxes, and insurance. What about the T&I portion of that mortgage payment? Your taxes, as we all know, are related to your market value.
Sure.
Market values are up.
Right.
People always also pay their insurance, making sure any sort of protection on hurricanes, fire, everything that's kind of currently been going on in the market as well. That's also tied to your market value.
Right.
So if you've just been barely getting by throughout this COVID timeframe, and you're seeing the average cost of milk and gas are at all-time highs. And you're now seeing that those folks that were already barely scratching by, now you're starting to increase the taxes and insurance on an annual basis. I think that's going the wrong way. So it's not that we're seeing data that's supporting that not happening. We're seeing data that's supporting that to happen.
Right.
So this is where, in a down cyclical market that we know is coming, it's not a matter of if. This is a matter of when.
Right.
Right. And we're not trying to play master predictor, but chances are what we're starting to see in the markets, especially in the Midwest, Ohio, Michigan, Illinois, Indiana, all the way down through the Southeast, corrections are coming. Right. So how far will that spread? Who knows? But 2023 is an exciting time to learn about this business and to get on in.
Yeah, I love that. So from a flow standpoint, I mean, how many houses do you think, I mean, if we were to guess, how many houses or how many mortgage notes are actually delinquent right now today?
Yeah. So this is public knowledge that everybody can research themselves, and whether it's through Black Knight or whether it's through your Google search, but you can see that there was already 800 billion
with a B,
with a big B, of delinquent paper pre-COVID sitting in top 5 major banks.
That was pre-COVID.
Pre-COVID. And then we all got heard of the famous word forbearance agreement.
Right.
Okay. So that's a Band-Aid on a wound that absolutely needs stitches.
Right.
Okay. So you're fixing something temporarily, but not permanently getting into the roots of why did they default? What's happened? Are you properly correcting it? Chances are you're not. And that's why 1 out of every 2 government forbearance agreements are delinquent. So what's that total? So that kind of tips the scale over 1 trillion of delinquent paper that is still sitting out in the market today, that is slowly starting to drip out into communities and neighborhoods in the market today. So that's why we're saying the correction's coming, the down cyclical is coming. Chances are you should learn a little bit about notes and how to diversify whatever investment process you're doing. Me and you were chatting earlier. Look at the stock market. Kind of it's in its down worst year since 2008.
Yeah.
We haven't seen this run, right? So what usually precedes kind of a down market? Well, chances are you kind of learn a different investment strategy and pivot how you're 100%. Investing. It's 100%. Go time.
I mean, I think that's why you've seen over the last decade people diversifying their current portfolio into precious metals and things like that. I think this is a great opportunity for people, for investors, savvy investors, to, at a minimum, learn about the buying and selling of notes. And that's why I think this is going to be such a valuable podcast for people to really dive in and peel back the onion and really just peel back that Chaz Guinn brain, because it's just, you know, it's some valuable knowledge that I think savvy investors are itching to hear about.
Well, let's talk about facts. We talked about facts tell, but stories sell. So the data back in 2008 is there was no market for a single one-off buyer or even portfolio level buyer to purchase notes, single family notes throughout the country.
Right.
That was done through seller financed or owner financed mortgages. They weren't sold in bulk or even in a one-off fashion from institutions prior to 2008.
Right.
They may have been done small trades in the secondary capital markets, but not in the mainstream like it is today.
Right.
Fannie Mae just put out a publicly traded deal, $974 million worth of delinquent paper, divided up into 6 individual pools. Okay. And we're starting to see that kind of accumulated to about 6,500 homes. And they've been kind of on that tear for the last handful of quarters, and they're not stopping anytime soon.
Yeah.
So if in the last 15 years, we've started to see this has birthed a new market. It wasn't here 15 years ago.
Right.
So now folks are really starting to kind of roll their sleeves up as, A, what is this? B, how can I stay nimble in today's market? Everybody's starting to compete for folks to come back into the workforce, back into the office, right? And people are fighting to stay at home.
Absolutely.
Well, here we are, a real remote-based career
option
for you, right? No forcing. We're having too much fun, and we want to welcome as many of you as to the space as possible. But we want you to do that ethically. We want you to do it smartly. We know that you need to have infrastructure, and that means a lot of different things and resources to people. So things we'll get into.
I love it. One of the things that we had talked about earlier. Here, cheers.
Cheers.
one of the things that we had talked about was in the last episode was being able to manage this business not only from home, but when you're traveling. We kind of touched on that. I think we're seeing that people are more productive working from home. I think a lot of companies realize that. We're going to talk about a lot of topics, but I think a lot of companies realize, oh wow, this 14,000 square foot space where we had everyone coming into, it's almost not necessary. I mean, these people are working from home. They're actually more productive, from a time management standpoint. I mean, it's giving people a lot more time and freedom to consider investment opportunities like this. They're looking at the stock market. They're not liking what they see.
Sure.
And so I think this is a huge opportunity for people to say, you know what? I'd like to dive a little deeper on this. And I think it's just been an absolute, a huge benefit for our audience and new audience that's discovering us every single day to come in and really, the first couple of episodes, they're getting a real education on notes from you.
We started to say, look, why are we only educating? Why are we only teaching? Why are we only bringing so few folks into the space each year?
Right.
And now is the time where we say we need to unlock that door. There are so many bright folks that we come across, whether it's in conference circuits, whether we meet you in airports, where you hear what we're doing and you're like, how the heck do I get into that space?
Right.
And there does seem like there's this big wall or this big barrier to entry.
Sure.
And we're starting to say, look, we need to tear that wall down. That wall needs to come to say, look, there are relatable faces and there are folks that are just look like you and I.
Sure.
That want to learn a new nuance to say, I still want to be around my family. I still want to attend those soccer games. But I also want to be able to help create a new generational difference in my family tree.
Sure.
We always say, who's going to be the one in your family, right?
Absolutely.
I think you say that you're the one in your family. I say I'm the one in my family. And we teach that a lot in our culture here at Revolve is you're here to change lives, both introspectively for yourself, for your family, but also for your community and your colleagues and your workers.
100%.
And that comes from learning and staying a constant student.
Oh,
that's the challenge. As folks starting to get to a certain space in their life, they're done learning. I already know what I know.
Yeah.
And we couldn't think differently here.
Right.
Is if you can stay as a student and continue to keep that coachable, sponge-like mindset
Absolutely.
to what you're doing, especially when it comes to real estate investing. Looks, we understand a lot of folks have good flow, good rental product, good fix and flip product. We've seen the bridge loan space, the fix and flip space, completely go kaboom over the last 3 to 4 years because the fix and flip space, because of how strong the market's been.
Sure.
Right? You can buy something for pennies, put some nice eyeball, good touch, good rehab dollars into these assets, and fix and flip them very, very quickly.
Right.
But we're starting to see that space slow down.
Right.
Right? Now we're starting to see real smart, sophisticated bridge lenders, folks that know the space, saying, what's next?
Right.
Well, if you learn the first lien mortgage space and you know residential assets,
Right.
you know how to value them, you know how to truly get resources there locally and be protected, we're starting to kind of breed and challenge and bring a new culture into this space to say, look, you can have your flexibility, you can still have your life, but also really be the one and change what you're doing
Make
from an
big
investment
moves.
style.
Yeah.
Absolutely.
I love it. Dude, thank you, Chaz. That's all the time we have today. Thank you for stopping by. We hope you come back. Make sure you like, subscribe, and add your comments. We want to start reading some of your questions and comments, so that way we can roll them into the next episodes, so we can really dive deeper with Chaz. Make sure you go to revolve-capital.com so you can learn more about what we do. And again, thank you for stopping by. We'll see you soon. Cheers.